Are ready. We're live. So, welcome to Wealth Wednesday. Happy Wednesday. Thanks to all of you guys for joining us today. We've got a great program lined up. Tim's going to kick us off and give us kind of the state of the union with the economy and what's happening in the market. And then Matt's going to come on and give us tons of education about indexing and index options and how to read annual statements and all that fun stuff that I know that we're all asked about that on multiple occasions. So, without any further ado, Tim, if you want to get started, we would love it and appreciate hearing from you.
Hey, great. Thanks, Kimberly. I'm up in Des Moines, Iowa today, so I'd taken a break for a minute and wanted to jump on real quick, give everybody an update. Um, if you've been watching my Tim Talks, I've been talking a lot about the bond market lately as interest rates have been increasing, which has been impacting the real estate market, been impacting the dollar. The dollar has been obviously very strong. The dollar affects gold, affects lending in across the board in all kinds of categories. Um, it obviously has an effect on the market as far as borrowing for companies, borrowing for lending in all capacities. And so what happened today, which was really interesting, is the Treasury, Bessett actually came out, and what they're doing is they entered the market here, and they basically doubled down, and they created a buyback, increased their buyback capacity from 2 billion to 4 billion, basically creating this liquidity adjustment that has eased the 30-year bond yield, cutting it almost 10 basis points right off the bat, which is a huge movement, as you can imagine. Uh, this is a big deal in the bond market. And by the way, the Federal Reserve is meeting, today to decide on interest rates, which my opinion is nothing's going to happen. Again, I think they're going to freeze. The leaning, I think the Federal Reserve is probably leaning towards just staying neutral the rest of this year. And if anything, if you think about Kevin Warsh and his role, being hired by the president, he's going to be more. I would think he's going to be more in that position to reduce rates. If anything, that's kind of, get the economy going kind of mentality, looking for reasons to lower the interest rates in order to also soften the effect of the 40. Now we're at $40 trillion, by the way, right at that brink of $40 trillion in the national debt. And with these higher interest rates, the implications of that, of course, if again, I comment on this quite a bit, is Kimberly and I were talking about this the other day, if you recall, Kimberly, about the effect of long-term interest rate debt carrying on our national budget, which is that's the third highest cost of our national budget, is the interest carrying costs of our national debt at $40 trillion. With these higher interest rates, that's a huge implication. Over the next 30 years, we're talking about 30 to 40 trillion dollars of borrowing that we're going to have at the 1.8 to 2 trillion dollar deficit per year, and that seems to be increasing right now if we don't curtail that spending by Congress, which is a huge number. At some point, it's going to have an effect on the economy. So this is something that I'm watching very closely. And everybody's talking about AI, talk about AI all the time. What's the implications of AI? Well, I think AI is pretty much baked into the economy right now. I talk about this a lot, that the S&P 500 is really no more than 41%, 40.7 was my last calculation. 40.7% of the S&P 500 is literally made up of AI driven stocks, mainly 10 companies control the majority of the S&P 500. It used to be about 20% of the S&P 500 made up of tech stocks. Now that's basically doubled. And also talking about, I want to go back to debt real quick, Kimberly. This is interesting. Back in 08, '09, at the end of '09, the national debt was $10 trillion. So from '09 to 2026, where we are right now, the national debt it went from 10 trillion to $40 trillion. I mean, just think about the expansion costs of where that's increased. I mean, that's absolutely incredible. So if you just multiply that out where we're going, it's not sustainable. At some point, the implications of that are huge. Now, we're coming up with the midterm elections, right? And no one's going to tackle the national debt. It's a political bomb, right? No one, either side of the aisle, Republicans or Democrat, want to deal with it. Republicans or Democrat don't want to touch the Social Security issue either, Medicare, Medicaid, which is a growing issue. As the baby boomers age, we're going to see more and more cost in medical costs that is going to transition into Medicaid, Medicare. And we're starting to see that now, and the numbers come out. So you've got this growing cost basis in government spending on all these in these cost bases in government spending. And so as this all comes about, it's going to have to be tackled here in the next couple years, 2, 3, 4, 5 years, or it's going to be forced on Congress at some point. And I see this playing out as, and it's going to be an issue. And I talk about the market correction. We're going to have one. I don't know what the catalyst is going to be. It appears, the most likely thing is going to be the national debt, but there's so many other things that could start the whole catalyst, the whole ball rolling. But there's a lot of different things that could actually start the market correction going. I mean, I watch it and I read about it a lot of times. They talk about it on CNBC, on Bloomberg. I read a lot of articles of the different things that could cause it, but no one really knows. I mean, it's just too many things out there. But again, technology is really the wizard, behind the scene that's driving the markets. That's one thing about America. That's one strength that we have is we are the leader in technologies in the world, and that's the one strength. So when we do get a correction, it does clean out the markets, and once that happens, we will be off to the races again. And I foresee a very strong market after that with not only AI, but go back to the basics a lot, I think is where I see all this is going. So the AI has already been baked into everything. I think every company is going to start seeing that develop, and any company out there not using AI will probably struggle. So our industry, for one thing, is always going to be the safe industry. We're going to need people to be the translators, people to be out there meeting with others to help them make the right decision, to help them be the translator, to help them, protect people to meet and help protect people, present products, present solutions. That's the one magical thing. Anytime there's a correction, the one industry that survives it all always are going to be the insurance industry where we are. We are in the safest place. This is why you got to go out and recruit. This is what we do. This is our strength. This is HGI's sweet spot. This is why this is the time to go out and build teams, go out and tell our story. I was up in Canada this last week, and one of the things, the benchmark of our story are the three things that make HGI unique. The first thing is Hubert created the system. This is over 45 years ago. He created the system. The system is something of magic. It really is that you can go out and have this this ability to go out and create a business model where you recruit people and you sell. You don't have to buy leads. You go out and sell to a market that constantly is available because of your recruiting ability. It's the system that he built, the LFS. And then you have this team of mentors, people that across all of HCI that cares, that wants to help each other. I call them mentors and coaches. I mean, it's like Kimberly and Zach and Jody and everybody on this team. Everybody wants to support everybody and help everybody be successful. And then you have the architect of the system. You have Hubert Humphrey here, who invented this system. He's the pure architect of the system. And when you have all those ingredients in one place like this, you cannot fail. I'm telling you, this is why you stick to this system and build off this system. You will be successful. And then we have carriers and partners like Matt, who's going to talk here in a minute. These are the partnerships that help us build and create teams and be successful and be able to distribute. So that's why this all works, and this is why our system is so successful. So that's all I got for you today. I'm sorry I got carried away on that a little bit, Kimberly, but I'm passionate about it.
No, I appreciate it. We always look forward to hearing your insights. And I know we all sound like a broken record saying a correction's coming, but a correction's coming. So it will be interesting to see when it happens, what triggers it, how long it lasts. But as long as we do what we do and keep spreading the word, then our people will be protected. And I think that's what's so great about the opportunity that we have talking to people. So today I'm going to introduce to you guys, you know him well, most of you know him well, Matt Salvatore with Corebridge. He is amazing. He's my favorite, not one of my favorites. So there you go, Matt. But he's awesome. He's always here to serve everyone, and always there to help and always there to answer questions. I know he comes to Atlanta quite often, but he's on today to teach us about indexing and teach us about how the inside of an IUL works, and then also what about annual statements when I have clients that are ready to look at this. What does it look like? So, Matt, I'm not going to take any more of your time. I'm going to turn it over to you and let me know how I can support you. You ready?
Awesome. Thanks, guys. Good afternoon, everybody. Good to see you all. Love to see many familiar faces on here and appreciate the fact that there's 50 people dialed in here on a Wednesday to hear me talk about the inside mechanics of an IUL. That's awesome. We're not going to go too in depth. I'm going to give you some insight that you guys can use to have more productive conversations with your clients. And the one thing I want to just start with is, and I'll ask Mauricio, I think I saw him join here, if there's a way for him to do this anywhere in the technology he's built. But I think it's so important for you guys to have annual reviews with your clients, whether you think anything's changed or not, or whether you think that there's nothing else you could talk to them about. It's so important because you are the value in the relationship. If you want to just be a transactional salesperson, you can do that. It's probably not the best product for you to sell life insurance and annuities, but you can go be a transactional salesperson somewhere, make a sale, and never talk to that person again. But I think a lot of the value that you provide from an education standpoint, but also when there is that market correction, right? You've got to be in front of that client. You've got to solidify why you made the recommendations you did and how it's going to help them through whatever that period of time looks like. And so from an annual review standpoint, I'd encourage you to download your book of business. I'm assuming you have to do this at each carrier, but for Corebridge, for example, if you go into Connext and download your book of business, you will see you could sort it by product name, you could sort it by date of issue, you could sort it by client name, a variety of different ways in an Excel spreadsheet. The reason why I'm suggesting this is because if you start to sort your clients by the date their policy was issued, you now have in order throughout the year people you should be calling every week and every month. It's already done for you. So question, Mauricio, is there a way to upload into a CRM, for example, dates of issue so that you can get reminders of who you should be calling?
Absolutely. Okay. Being in the industry, so Webley, as a matter of fact, be a great idea. And today at 2:30, I'm going to take a few minutes just to show you how we could do exactly what Matt Salvatore is suggesting.
Perfect. I love that because again, As a insurance veteran, right? When I first started in the business, I actually bought insurance from another person, right? I didn't sell it to myself. I bought it from somebody else. And he calls me every April, and it's oftentimes a very quick conversation. Hey, just so you know, your annual premium is about to come out. Anything we need to change? Are your beneficiaries still correct? Has anything changed? Do you need more coverage? Right? We have that conversation. Oftentimes it's very quick. Yes, beneficiaries are still the same. I'm still married. I think the amount is still right. I'm ready for that draft. What date is it going to be on? How much is it? We just have that very quick conversation, right? So that's just the annual review on a basic term policy. Are your beneficiaries right? And is this still the best product for you and the best face amount? When you're talking also about term insurance, don't forget about the term conversion part of that conversation. If you're reaching out to these clients every couple of years, it may make sense for you to explore the term conversion. And then really what brings us into the conversation today is reviewing index performance and reviewing how the policy is actually performing once the annual statement is generated, right? So the annual statement comes out annually, a couple of days after the policy anniversary that will show you where the client is, right? How their policy is performing. Now they get a copy of that in the mail. And if they're signed up for the consumer portal, which they should be, they should get an email that something has been uploaded to their account. But what are they doing with that, right? They're looking at the statement. They don't really understand it. And they kind of just say, all right, I hope this is still the best thing, that I could have. And they kind of just file it away or throw it away. And that's the end of the conversation. That leaves the door open for somebody else to come in and either replace that policy or talk negatively about you or your company or the product, right? Whatever it may be. And so if you know that annual statement is going to generate on September 1st, you should be calling them on September 1st or September 2nd. Hey, you're probably going to receive a piece of mail. Let me know when you have 15 minutes or we can hop on Zoom and I'll walk you through exactly what you're going to receive in the mail. Do you think that shows value? Do you think other people are doing that? That's how you as an agent will grow and build your influence and build your trust, build your credibility. Each one of those phone calls is another opportunity to get referrals, right? Hey, we talked about this 2 years ago. It's doing exactly what we said it would do. Now that you've been in it for a while, who else do you think we should have this conversation with, right? It opens the door to conversions, conversations, referrals, so many different things if you're just following up with your clients once every year on that anniversary. And again, with technology, you don't need to guess when the anniversaries are or think of a client and then pull up their policy and find the date. Sort it in a spreadsheet, and you now have people to call every week of the year on something. Especially if you've been in the business for a while, you could talk to any one of those people, and you kind of have your calls set for the remainder of the year. Now, with that all being said, let's talk about indexing. I know this is a hot topic. IULs and index annuities have been just on fire lately. It's incredible to see the growth in the business and kind of the shift away from other products towards some of these index products. But I also want to give you some resources so that you can go and dive into some of this stuff yourself. As you know, we have a phenomenal marketing website that houses most of our materials. Some of it is consumer focused, right? Product guides, rider guides, product highlights, etc. But there's also things for you as an agent to understand, how do I actually continue to be profitable in this business and provide value to my customer? And so one thing that I'll share with you guys here, if I can pull up the website. Let's do this. Let's move this over here. Let's move your faces over here. All right, let's pull this up here. Share, 1, 2, 3, perfect. So on the marketing website, the Standout with QOL, which I talk about all the time, if you go to QOL products and then go to either protection or accumulation, doesn't really matter. I think most of these conversations are going to be accumulation focused. If you scroll down, there's a section here dedicated to policy statements, right? Annual statement, how-to guide, how to read the annual statement. It's about 6 pages, a number of different numbers and percentages, and people don't really understand how they work. I don't expect consumers to. And if you're new to working with Corebridge or new to selling IUL, I don't expect you to know either. But we have that guide for you here, as well as an FAQ of how to actually read the annual statement. So I'm going to go through that document with you in a few minutes. In addition to understanding how the statement works, you also have to understand how indexing works. And so again, if you're newer to the business or never really had the crash course on how indexing works, under the product section, we also have a PowerPoint deck called Understanding IUL Index Interest Crediting, right? What a concept. It's right there for you to review. And that's a little in depth, right? I'm not going to go through that. I'm not an actuary. I don't think many of you are actuaries. It's intense information, but sometimes you can pull a couple of notes out here and there to help you in your conversation and learn more about how some of these products work. But let's go through this first. Annual statement how-to guide. You can see on the first page, it's going to give you all the basic client information, right? Who the policy owner is, email insured, the issue date, their premium, the product information, the death benefit. And then it will show you a summary from last year to this year. What changed? What's my accumulation value? How much premium was paid? How much index credit was earned? And then what were my charges or withdrawals, right? Then it will show your accumulation value and ultimately your surrender charges and your net cash surrender value. Everything's pretty straightforward on this page, and clients oftentimes look at that and they say, okay, yeah, makes sense, right? But you got to be able to explain this and walk them through it. I encourage you to pull up the statement on Zoom with the customer and go through section by section. It'll give them more comfort in what they own, and it'll give you more confidence in talking to more people about the strategies that you implement for other clients. As we scroll down here, you're going to see the allocations, right? How is this client currently allocated, both in a dollar sense and also a percentage across all of the indices that are offered, all right? So you can see here, this one, they've got about 111,000. It's split really between the S&P participation, the S&P cap, and then they've got some money in a declared interest account for whatever reason. But that's how they're currently set up, and you can kind of walk them through the rebalancing conversation and why you chose multiple indices. Hopefully you did. More to come on that later, but this will give you the conversation to have with the customers of how they're currently allocated. On the bottom of the page, it goes through termination dates. Right here, it will show both guaranteed and current assumptions. If you pay no further premiums, when this policy will lapse, and if you continue paying your premiums, how long this policy will last. The current assumptions is really going to be where I focus. That's going to be what you typically see on the right-hand side of the illustration. The guaranteed side are maximum policy charges and 0% credit. So a much more unlikely combination of factors. The current assumption is really what we're basing all of our assumptions and illustrations on. Now we go a little bit further. Again, it'll show the allocation from a percentage standpoint. Pretty cut and dry here, not too much to look at. But when we get a little bit further, it will start showing the individual buckets that are maturing, right? So these are all 1 year point-to-point index options, which means that this contribution was made September of 2023 and matured September of 2024.
You're trying to help from over there by dump.
I don't think that's a question. I think that's an unmuted participant.
I got it.
Okay, thank you. And so here it will show you what the beginning value was in that index, what the ending value was, and what the growth was. And then we apply the floor, the participation rate, or the cap, and it will show you then what the net index growth rate is. You can see here these are two different S&P account options that averaged on this particular period 8.27 and 7.7. Again, this is from 2023 as kind of a sample statement, but I will show you real life statements I pulled this morning from a couple of your clients. As we get further down, it'll take all of the index options that you have chosen. Sometimes it's 2, sometimes it's 4, and it will average them together, right? Because when you run an illustration, you're oftentimes running it at whatever the current rates are and saying it's going to be 7%. Okay, well, one might do 10% and one might do 4%. So does it average to 7? Because that's all I really care about. And that's really what this page will show is the average of all of your indices together, what the average would be for that particular segment. Right, and then it just goes through in a little bit more detail. It really breaks down into what's happening month by month. So what happened in October, what happened in November, what happened in December, et cetera. So it really dives deep into it. I don't see a lot of customers or even agents really asking about these pages because it's just a 12-month breakdown of the prior 2 pages. So it really goes in depth where if you don't have a great year, you can go back and pinpoint, hey, remember in March of 2020, that's when the COVID pandemic struck, right? That's when the markets tanked. But then July, August, September, things started to rebound. And you can see that and have that conversation with the customer when you're looking at it month by month, but probably not necessary for many people. And then on the last page, it'll go through any loans, any money that you have outstanding on the policy, whether that's a standard loan, participating loan, any loan repayments that were made, your ending loan balance, etc. So it just goes through all the different components of that client's policy. And this is accessible to the client in the consumer portal. It is mailed to them once a year, and it's also accessible to you as the agent in Connext. So as the agent in Connext, if you pull up the client's policy, go to the correspondence tab, there is a section dedicated to statements, and it'll show, 2 to 3 days after the anniversary every year, that statement will be generated. And I, again, encourage you to pull them up, look at them, see how they're performing, and make those phone calls to the customers, whether good or bad, right? You've got to be in front of the customers and either talk about what you did, how great it was, or defend what it is that you did for long term. But that's kind of the how-to guide for annual statements. Again, I think this is something you should pull up, kind of read through, look at some examples of it to hopefully give you a better understanding of how these work. I'm going to pull up a couple of real statements in a minute, but any questions so far? Kimberly, any comments you want to add?
No comments other than how magical it is that you guys have it in the back office.
It's all
on the
there
QL
for you.
website. It's like, oh, guess what? We do
It's
that.
all there. All right, so I got 2 HGI cases I pulled up here kind of at random this morning. But this is an anniversary of July 21st, right? So we're about a month away or month past when that statement generated. And this is a $2 million face amount. Client's paying about $1,800 a month. I don't know the client's age here, but that really doesn't matter. What you'll see is a few different things, right? You'll see that because this was a fairly new policy and they've taken some loans out and paid some loans back, there's a lot going on here. But really what I want to focus on is not this first page. It's really the second and third page that I'll address here. And the first thing I'll point out here is, if I can get my pen out to the right color. Okay. When this application came in and we issued the policy, it was a 25% spread across all 4 of our index strategies, right? So the Merrill Lynch, the PIMCO, the Franklin Quality Dividend, and the S&P High Cap. It's gotten a little out of whack, and this is natural for this to happen. Over time, as one index performs really well, maybe one slows down a little bit, things are going to get a little out of balance. There's nothing wrong with that, but just make sure that if it gets too far out, and I see Stuart looking at me, right? Just like in a VUL contract, if you have an allocation you set from the beginning and over time that drifts, well, now their entire outlook is going to drift, right? And it might not be appropriate. You might be overweight in one area. Same thing in your 401k, right? You got to rebalance things over time. So just keep an eye out for this. Make sure it doesn't stray too far from what you originally set forth. And if it does, you can always make some changes or move some money around if necessary. And right here, we'll show you what the allocation summary is, right? So this is allocation of new dollars. It'll show 25% across the board. The prior page showed what the actual balance is today. And so this shows where new money is going, and it is appropriate, 25 across the board. But again, it sometimes gets a little unbalanced, which is natural.
Hey, Matt, I know you're
Yes.
probably going to say this, but while you're right there, let's talk about when you can make changes to what?
Sure. So from a reallocation standpoint or a rebalancing standpoint or redirecting future premiums, you can't just do it at any time you want, right? Because these are all one-year strategies. And so once you make a premium payment, that money essentially gets locked up for a 12-month period, at which point then you earn an index credit at the end of the year, right? At the end of that 12-month period. So at any time, you can redirect new dollars into a new strategy, either a new index or a new combination of indices, right? You can do that at any time saying, hey, any premiums I make from this point going forward, I want it allocated this particular way. And we can make that change for you on a monthly basis. If you have a bunch of money in one index and want to move it to another, you do have to wait for that index to mature. So you would essentially send us a request a few weeks before that index matures, and then we will make the change. So when that money gets unlocked, we can reallocate it and lock it into another one-year strategy. So really 2 components to know there, right? On new money, new premiums going forward, you can change that balance or that allocation at any time. For any existing money in the contract, any existing accumulation value, you do have to wait until that bucket matures before you can move it into something else or change the strategy on that. She's still on mute, which means I answered the question. Okay, So let's look at the matured index accounts, right? And as I mentioned earlier, this is going to show you month by month kind of what's happening within the contract. Now, ironically, this client skipped some premiums, and so you're not going to see something mature every month, but it will show you year to year, month to month within the year, what is happening with that index. And unlike many other products where you could say, hey, you know what, I had a really great year, it oftentimes doesn't matter what your year was. It matters how the month to month was, right? The month of one year to the month of another year. You can see in some situations, you know, the client netted 11.13%. In the same index earlier that year, they got 1.2%. It's just a matter of timing. When the market's up, when the market's down, when do you buy, when does it sell? There's a lot of components into it, which really leads me to the point of diversification. I think that's very important to have money across a variety of different financial products and in different indexes and different sub accounts, depending on which product you're in. To be diversified is very important. But this shows you here what the growth rate was of the index. Then we apply either the floor, the participation, or the cap. In this case, it's a participation rate account. You get 105% of whatever that index performed at. Okay, on the PIMCO, you're going to get 75% of whatever that performed at. And this is going to be what actually gets credited to your policy. Okay, so does that make sense? We got the underlying index month to month, the value in that particular monthly bucket, what the index grew by, and then when you apply the floors, the participation rates, or the caps, the last column is what actually gets credited to the policy. All good so far?
I think that makes total sense. Just to recap, I'm just kidding. If it's an annual premium, it's annual point to point, correct?
That is correct, unless you have the dollar cost averaging rider, in which case we will drip those money into those indexes, because if you put it in, in August, and then a year later you've got a 1.2%, you're going to be pretty upset, right? And so most annual payments are done with the DCA, where we spread it out over a period of time so that you do have, the potential for not just one rate, but 7, 8, 10, 12 rates.
Okay, thank you.
You're welcome. This again just continues on. So they're again spread across 4 indices. So this page here shows the MLSB and the PIMCO. And then this page will show the FQD and the S&P. Okay, so you may not see all 4 of these sections if your client's only allocated to one, or maybe you see 3 of them, or maybe 2 of them, but just know that it's going to show whichever one the client is allocated to. Now, the next page will show what the average of each of those indexes was, right? So for the MLSB, for this full 12-month period, it averaged to 6.12%. The PIMCO, all of the varying index growth rates, when you average those all together, ended at 7.05. If we continue on, same story, 5.8 in FQD, 11.65 in the S&P, and then the following page will show the total average, the weighted average across all 12 index segments across all 4 of the different index options you have. So this is really the number that most clients are going to be looking at, right? I've paid in X amount of dollars. What was my return on that growth? The illustration was ran at 7%. Am I ahead? Am I behind? Am I right on pace? This will give you that information. So this continues on. Again, it breaks down into each individual month. There's a lot of information in here about expense charges, cost of insurance charges, your premium expenses, what the index account interest was. So tons of information within the annual statements. But I'm going to take a guess that this is probably the first time any of you have even seen an annual statement from Corebridge. So just take that time, go through those clients you've sold in the past, see which ones most recently had an anniversary, and start making your calls and reviewing some of this with them. It doesn't need to be in depth, but just stay in front of them. Let them know, hey, we illustrated 7%. You got 7.8. We're right on pace. Things are going well. Do you have any questions? Right. And hopefully that's going to, again, show some more value from you as an advisor. Now, the questions I typically get are, well, what are the index options? And this is going to be changing. We're about 5 or 6 weeks shy of a reprice on the Imperial Plus product. And when we reprice that, I think the go live date is October 1st, if I'm not mistaken. We will be introducing a new index option called the NASDAQ 100. Super excited about that. I think that's really going to be, one of those indices that we look back on and say, gosh, people just got all sorts of crazy returns there, right? Because the NASDAQ is all very heavy in tech, right? Non-financial companies. And so no banks, no insurance companies, no financial companies in there. It's predominantly healthcare and tech. And that's really where we're going to see a lot of the growth over the next couple of decades, right? Tim talked about the AI that I think every company at this point is using. And if you really want to see significant growth, the NASDAQ is going to be where you see it, because those are the companies that are on the cutting edge, on the forefront of that tech initiative, that AI initiative. And we're going to see some really great, hopefully, index credits from the NASDAQ 100. But that's going to be coming in October, hopefully October 1st. And I will give you more information once that is launched and we have data to show you and product guides to share with you. But for now, we still have a very competitive product, the Imperial Plus, which is the HCI dedicated accumulation focused IUL with 4 different participation strategies. Now, again, this isn't something I would show to your customer, but this is just for you to know what the options are. When you run an illustration with Corebridge, the default is going to be the S&P 500. The default is the S&P 500, and that was changed maybe a year or less ago, right? So anybody you sold historically, the default for many years was the Merrill Lynch Strategic Balanced Account, right? Nothing wrong with that account. The MLSB is still one of our favorites, but it does have a different purpose and a different use and illustrates a little bit differently, right? So you got to just know how these things are all working together. From the different options we have here, right? If we just talk through these one by one, and we do have guides for each one of these as well. We have the full workup of the MLSB, what it consists of, what the returns have been, who it's appropriate for. We have pieces on every one of these indexes available on that same website. But the Merrill Lynch is really designed, along with the PIMCO and the Franklin, to be a volatility control index. And so in times where the market is very volatile, big swings in the market, the MLSB is going to be a slightly lower but more steady approach. We've been in a very volatile market for a number of years. Although it's been on the upward trajectory, it has been very volatile. For those of you that watch your account balances regularly or watch the news regularly, there's days that it's up significantly. There's days that it's flat. There's days that it's down. It's always going to be that way. And so the volatility control indexes give the client the ability to hopefully smooth out some of those valleys and those peaks. And I'll share this with you real quick. Let's see, that's the wrong one. I got too many things open, guys. Where is it? Well, that's okay. Just know that even though IUL has floors and caps, here it is. Even though IUL has floors and caps, it's still volatile. That red line is what we're typically showing in an illustration, right? We're showing the client a 6% or a 7% steady rate of return, a steady crediting rate. And that just doesn't happen, right? You have years that are 18%, you have years that are flat. So even though there's not necessarily inherent volatility in an IUL, there can be volatility in what gets credited on an annual basis. And so it's just so important to monitor these policies and see, is it up, is it down, is it right on pace? I think when you average this all together, you'll find that a lot of them end up very similarly to the way they were illustrated if you ran a conservative illustration. Prior to some of our regulatory guidelines where we had to limit our illustrated rate, if you were shooting for the moon and showing a 10 or 12%, we all know that doesn't end well, right? Because there is volatility from that sense. So when you're running these illustrations, running them at 6 or 7% flat is a kind of a standard practice, but just know that you will have ups, you will have downs, depending on which index you're in. You cannot avoid any of the volatility. Gail, do you have a question?
I do. Ironically, October is the anniversary of my IUL. And so I'm curious, is the new NASDAQ index, will that be available on existing IULs or just on new ones moving forward? And is there a cap on it?
Good question. As for right now, it's only going to be available on new sales. Not saying they won't introduce that later on influx box of business, but that's a completely separate process than just adding an index or repricing a product. we've got to go back and refile all that with all the existing policyholders. So there's a lot more to that. The in-force cap, par, and index management is completely separate from what we do from a new product perspective.
Okay. And is there going to be a cap on it?
There is. I don't know what it is. I imagine it's going to be very close to the S&P. They're 11 and a half, 11.75, somewhere in that range. I will give you the one caveat, Gail, because you're probably thinking, well, crap, I wish I could participate in the NASDAQ, right? That's why you asked the question. The NASDAQ is going to be some of the driving force of kind of the next wave of this market, right? The AI, the tech, those heavy companies. But a lot of the companies in the S&P will benefit from what those companies are doing. So it's not that you're not going to get the exposure in the S&P. You're certainly going to get that because a lot of the 100 in the NASDAQ are also in the S&P. The only difference is you have, some other types of companies in the S&P. So,
Right.
You may sacrifice a little bit on the high upsides, but I think if the NASDAQ is up, the S&P is going to be up pretty similarly.
Can you show me where to go to request the document to make those changes to the index on my anniversary?
Yes, I will show that to you. Let me jot down and I'll show that at the end of the call.
Okay. Thank you.
You're welcome. Get my pen to work.
And just to be clear, while you're doing that, you can make changes on new contributions immediately. You don't have to wait for anniversary. So I just want to make sure people understand that clearly.
That is correct. And then, one other point I'll make about the anniversary is, you can send that form into us a month, 2 months before, and we know that it's going to be for the anniversary. You don't need to try and time it so that it arrives on the same day that it matures, right? There is that customer-friendly window where if we receive that index allocation change on existing funds, as soon as those buckets mature, we will then initiate the allocation change. Yes, Mr. Gamara.
Hey, Matt, good to see you, man.
Good to see you, brother.
Okay. Quick question. When the STEMIC shows an interest that was credited to that client, that is after all the expenses, right? Is a net or they have to?
Yeah, good question. So the charges for a policy come out monthly, and so those are always happening, and then the index maturities are happening monthly as well. And so the number that you're seeing is net. And the expenses, if you look further on the statement, it shows you, what your premium was, what came out in charges, and then what got credited. So it goes in that order, right? Charges come out first, and then credits go in afterwards.
Also, thank you.
You're very welcome. Back to, let me reshare here. All right, back to this page here. I think the standard going forward, or the default, I know the default going forward is S&P 500, but you may have clients that are fully allocated to the MLSB. It's probably worth the conversation to say, listen, MLSB is not bad, but let's introduce some of these other indexes. Let's have some varying exposure. Let's try and get you some higher upside based on how their policy was performing. Because Merrill Lynch is not intended to be this market chaser, these high returns, it is really good in those volatile markets, but you can see higher returns or higher credits from either the PIMCO or the S&P. Now, the next page will show you that 20-year look back. Let me try and zoom in a little bit on this. The 20-year look back of each of the 4 indices. You can see they all average out to relatively the same amount in terms of what was credited, right? Because we have caps and pars, right? So even though the total return might be significantly higher with one, when you apply the caps or the pars, they all end up averaging pretty darn close together, between 5.7 and 7.4%. But you certainly want to have exposure to as many as possible. The last page of this document shows you or gives you an idea of what each of these 4 index strategies consists of, right? MLSB is really domestic treasuries, bonds, and cash, right? We heard Tim talking about that earlier. As an econ major, it makes sense to talk about the bond market and how that's impacting the overall equity market, but you got to have exposure to a couple different ones. So if somebody is more conservative or more fixed income oriented, then the Merrill Lynch Balance Account will be a really good option for them and provides a hedge against the S&P volatile periods. Then we look at PIMCO. PIMCO is a global index strategy, right? Typically carries higher volatility, but it's for individuals that are looking for more diverse options in the global economy, not just here domestically, right? So another different strategy for you. The Franklin is really for those large companies that issue very stable dividends. Again, it could be really good when the domestic equity market is strong, because those companies like AT&T and Verizon and Coca-Cola and all these large companies that have been paying dividends for a long period of time will give you some stability there because their dividends are pretty stable. So those are the three volatility control indexes, all operate a little bit differently, but offer the client the ability to smooth out some of their their swings that you would see really anywhere else. And then on the bottom, you've got the full S&P 500. Again, domestic, really looking for those higher returns as a result of all the companies we see in the S&P 500 today. So a variety of different options here. I'm a big fan of choosing 2 or 3. I don't think it's necessary to do all 4, but I think the S&P should be a big piece of that, and then filtering either the PIMCO or the MLSB or the Franklin into that as varying options as well. So this again is available to you guys on Connext and also on the marketing website called Index Strategy Options. Index Strategy Options. Let me see. I had something else pulled up here I want to look at with you real quick. Let me find it. Okay. In the product guides, there's also information about the indices. And so this is the Imperial Plus product guide. And if you scroll through this all the way, you've got one mention of the different indices here, right? And it kind of gives you that storytelling. As you guys know, it's all about the stories we tell. We've got to be able to articulate what each of these indices means to our client and why we're suggesting they go into 1 or 2 or 3 of them, because they may ask, and you've got to be able to have that story behind it, not just a graph of numbers, right? This gives you some of that story behind what your suggestions may be. As we go further and we get to this section, the product highlights, again, in this section here, we've got the index crediting strategies, which talks more about, from a bullet point standpoint, what each of those indices is designed to do and deliver for your customers. There are some differences across Imperial and Value Plus Protector, depending on what the focus is. There are some different index options. One that was introduced recently on the Value Plus Protector is a high bonus account that will also be coming to the new Imperial Plus in October. So we'll have the NASDAQ and the S&P high bonus, which will be coming again in about 6 weeks, and we'll give you more information once those officially launch. But with that, I will pause there real quick. Again, see if there's any questions, any comments, anything else you'd like for me to cover in the next 8 to 10 minutes.
Yes, there is. I would like for you to specifically address the first annual statement, because I know that's a question I've had recently from several of my personal clients and also reps, and because they're not going to see those credits, right? And I want to make sure everybody understands that, especially if, they're going back and doing annual reviews like they should. What do they say when there's not that big lump sum credit at the end of year 1 because it hasn't matured?
Yeah, great question. So I'll address this in 2 different, whatever, let me just go. The annual statement is based on the effective date of the policy, right? So if you have a policy date, this will never happen because we're closed on New Year's Day, but let's say January 1st is the effective date of the policy. That's when the policy is delivered. That's when we draft the first premium. That is not when the money goes into the index for the first time. It's typically a few days or weeks after that. When that net option window opens, right? And so if you have on that first anniversary, January 1st of the following year, you will receive a statement because it's automatically generates on the anniversary, but you will not see any index credits yet, right? So from a statement perspective, you will not see the growth or the index credits on the first statement. You will see it on the second, the third, the fourth, the fifth, etc. In Connext, in the correspondence section, I mentioned to you there's a drop down for statements, annual statements, and that's where that document will live. There's also a drop down for what does it say? Enforced correspondence, I believe. Now I'm blanking on it. I think it's the next drop down. It says enforced correspondence, and in there it will show you the monthly credits as they mature. So 13 months after that policy is placed in force is when you will receive your first confirmation of an index credit. And you will see that every month. We don't mail those out to the customer. We don't mail them 12 pieces of mail per year. We mail them one annual statement, And then the monthly statements are just in either the consumer portal or in Connext. And so, again, the conversation, if you're in front of your clients, you should be able to handle this. It's on a reactive basis. That's not a good conversation. When the client calls you and says, hey, I got my statement, I don't see any growth, what's going on? I put $18,000 in this, cancel this. Then you're on the defense. But if you're ahead of it and say, listen, your policy's anniversary is coming up, there's going to be a statement that's generated and mailed to your house. Let's set some time up to review on Zoom. I'll talk you through it. And then when we start receiving those index credits, next month we'll do another call and I'll talk about what actually happened with the money that you put in last year. So that is one discrepancy, right? The statement is generated based on the policy effective date, not when the first dollar went into the index allocation.
And I think starting year 2, you will see statements, or you will see all those credits on an annual statement like typical. I just wanted to make sure that you guys understood if you saw nothing in year 1, it's not because they haven't actually made money, it's because those segments have not matured yet. So it's just important to know and to explain.
Exactly. Gail, I know you had a question about where to find the allocation form. I've got to log into Connext here, which might take me a minute. But it is in Forms Depot. So if you go into Forms Depot, you can either search by like in-force business and then choose your product, and it'll give you all the available forms, one of which will be an index allocation change form. You could also just go on Forms Depot and type in the search bar index allocation, and that change form will come up. If you have any questions of actually making the changes, let me know. But that form is available in Forms Depot. I just can't get into Connext right now. James, you had a question?
Yes, sir. Great training today, man. That's a lot of great information. Yeah, this is, I think, deep dive for everyone into what an IUL really does, which is awesome. So quick, you mentioned at the beginning downloading an Excel spreadsheet of your book of business. Where on Connext do we do that?
Yes, good question. So in Connext, let me see if I can get back in here. I was impersonating and it kicked me out, and now it's a whole disaster. If we've got another couple minutes, I'll show you where to do that. But long story short, if you're in Connext and you go to My Business, the first thing that's going to pop up is all your new business, all your pending applications. But then there's a tab that says Enforce. And when you click on Enforce, it will then give you all your business. Now, from there, you can sort it by if you only want to see IULs, you can do that. There's a number of different filters that you can apply in there. But once you have Enforce selected, there's just an export link right below it that will export it all into Excel. And then from there, I think it makes sense to sort it by date of issue because that will give you that call log for the next year of people to reach out to that you've previously talked to, kind of in order. And you can get ahead of those statements. You can get ahead of any mail that comes out, make sure the premiums are all up to date, et cetera. The only filter maybe I would change is only select active policies. No sense in you calling on a policy that lapsed 3 years ago. So just select your active in-force policies and then click the download. It's right underneath some of the search filters.
I want to remind all of you guys on Tuesday, the 25th, which is obviously next week at 7 p.m. I'll share the flyer at the home office. We have the Money Matrix. Matt will be there. Zach and I will be there. Obviously, James, the entire Atlanta crew will be there. But it is an IUL focused client facing event. So it's going to be amazing. It's going to, talk about all the different ways we can use an IUL. We're not going to go into deep dives of indexes and things like that. Obviously, it's going to be more stories and sales concepts and sales ideas and understanding how they can use it. But make sure that you're there. If you live too far away, that's your only excuse. We will live stream it. We're going to live stream it to HGI Team Legacy so you can watch it there. But if there's any way possible for you to be there in person, be there in person. You're going to learn so much, and so are your clients. We're going to sell for you, so let us. So just wanted to make sure that I plugged that and everybody knew about that so they could do that. And then there's a registration page, right? So if you just scan to register, then we'll have your information. We'll know that. Matt is gracious enough to provide hors d'oeuvres, whether he knows it or not. I'm just kidding. Did you know? You've been tapped.
Yes, I
know. So we need numbers for that too, right? We're not feeding hors d'oeuvres to the live stream people. Just kidding. So just make sure you register, especially if you're going to be local. So we have a head count, and super excited to see all you guys there. Matt, anything else you want to talk about? I was going to open it for a couple of questions at the end if anybody had any, but anything else you want to say?
I will leave you with one teaser. And if you are coming to the event in Atlanta, find me and ask me more about it. But question I would start asking your clients, especially your clients that are 30, 40, early 50s, high income earners, do you currently have a plan to generate guaranteed, rising, lifetime, tax-free income? Guaranteed, rising, lifetime, tax-free income. That's all I got.
We just need a t-shirt.
I like it. I'll work on it.
Yeah, thank you. Awesome. Well, thank you so much. Anybody have any last minute questions that you want to ask before we have probably time for one or two? You're quiet today. You've taught them everything. They know it all. Nobody's calling you anymore, Matt. You just taught them everything.
Cool. I just want to remind everybody again that 2:30 it's training. So I know we have a great crowd today. Just make sure that if you want to learn more about the tools and how to, import some of those clients into a CRM so that you can remind them of policy anniversaries and things like that, and much more. We'll see you at 2:30 here shortly.
2:30 Eastern.
Yeah, you get an email. Just look on your email, check your spam box. Colton sends an email around noon to y'all. It's technology training. You should see it on your email. See you there.
Awesome. Thank you, Mauricio. And all right, Maria, last question.
Good morning. Good afternoon now. Matt, I am in my back office and I am in one of my clients that is over a year. And you say to go to the policy summary, and after that, I have the policy packet and the policy summary.
Not policy summary. So if you're in Connects and you go to the correspondence tab, let me pull up a policy here.
I am in correspondence.
Yeah, so you should be able to scroll down further. And I'm assuming this is an IUL you're looking at?
Yes.
Okay, so under correspondence, there's going to be the policy summary, but below that, you've got, let me share this with you.
You just have to open that little triangle.
Yeah, let me just share this. I've got it pulled up here. Yeah, so you've got statements, confirmations, in-force correspondence. The new business and application, that's the original application. That's anything from a new business standpoint. Most of that is going to be behind you if the policy's in force. Statements will show here, annual statements. And then the in-force correspondence is where you're going to see all the monthly index credits, as well as any bank draft changes. Anything that the client requested or anything we had to mail the client is visible to you here. So you should never be in the dark of what's happening with your customers.
But then when are you going to get the annual report?
The annual statement, what was the effective date of that policy?
The policy, 1 second. It's Nicole Frias, and it was the effective date. It was 8/28/2024.
Okay, so you probably won't see it till like September 1st or so. Because 8/28 will be the anniversary, which is still 9 days away. And then a couple days after that is when the statement will generate.
Perfect time for me to call.
Absolutely.
Awesome. Well, thank you so much, Matt, for sharing and teaching us and doing all you do. Guys, don't forget this is live streamed to YouTube. So if you want to watch it again, you have that at your fingertips. So you can go watch it, rewatch it, train yourself, and just make sure you know where all the tools are that you have available to you. We will see you next Tuesday night in Atlanta, and I'm sure before then too. So talk to you soon. Have a great Wednesday, whatever day it is. Bye, guys.
Thank you.